84 cents per unit. I mean, that is a 28% jump year over year.
Right.
And net income just hit a massive record of $1.8 billion for the second quarter.
Yeah, and adjusted EBITDA wasn't lagging behind either. We're looking at a record $2.8 billion, which is up 17%.
So they absolutely crushed it. Welcome to the Deep Dive. Today we are unpacking the Q2 2026 earnings report for the midstream giant Enterprise Products Partners. Ticker symbol, EPD.
Right, and we're pulling this directly from their official Q2 earnings press release and, their earnings support slides.
Exactly, because it's not just about reading off these headline beats. Our mission today is to decode the mechanics here. Like, how do global geopolitical shifts, massive infrastructure projects, and a remarkably strict capital allocation playbook all collide to create a quarter like this?
And, well, more importantly, what it means for you as you try to navigate the broader energy market right now, because the sheer scale of the volume here is staggering.
It really is. So for context, and I know most of you know this, but just to quickly ground us, EPD is a midstream company. So they aren't the ones drilling for oil, and they aren't the utilities selling gas to your house.
Right, they sit right in the middle. They're the circulatory system. Their entire job is moving, storing, and processing energy.
Gathering it from the wellhead and pushing it through thousands of miles of pipelines. And the volume moving through that system this quarter was just insane.
Oh, totally unprecedented. They reported record equivalent pipeline volumes of 14.7 million barrels per day.
Every single day.
Yeah.
Which is an 8% increase year over year.
Yeah. And crucially, it's not just staying inside the U.S. If you look at their marine terminal volumes, so the energy they're loading onto ships for export, that hit a record 2.8 million barrels per day.
That's a massive 33% jump from last year. So naturally the questions of why? Why this specific quarter?
Well, the sources point to a very specific macro catalyst in April and May. Strong international demand for U.S. energy, heavily driven by a rush to backfill volumes affected by hostilities in the Middle East.
Right, global shipping routes were in absolute chaos. But I have to challenge that narrative a bit. If global supply chains just randomly break down, how much of this record quarter is just EPD getting incredibly lucky with geopolitics versus actually executing on a strategy?
I mean, it's the classic definition of luck being preparation meeting opportunity. Yes, the geopolitical spike was an external shock. Nobody predicts exactly when transit times will suddenly double because ships have to route around conflict zones.
Right, you can't model for a sudden war.
Exactly. The world suddenly needed U.S. energy to fill a void immediately. But here is the reality of the midstream business. If you don't have the physical pipes in the ground and the loading docks built, you absolutely cannot capture that demand.
Because you can't just email oil across the Atlantic.
Right. If a buyer in Europe needs 1 million barrels tomorrow and your loading dock is full, you just watch that revenue sale pass to your competitor.
So how did EPD actually maneuver to capture it?
They actively accelerated the completion of construction and the commissioning activities for the expansion of their Neches River terminal in Texas.
So they basically pushed all their logistics and safety testing into overdrive to get that second phase online ahead of schedule.
Exactly. So right as the global market started screaming for backfill energy, EPD effectively opened a massive new valve at the dock. They caught the wave perfectly because they built the board in time.
Okay, that makes sense. But here's where my skepticism kicks in. Geopolitical spikes are temporary by nature. Supply chains eventually adjust.
They do, yeah.
And Jim Teague, the CEO, even noted that terminal volumes returned to normal in June and July. So if these spikes are fleeting, how does EPD protect its baseline? How do they ensure the business survives when the world isn't panicking?
That is the existential question for infrastructure. And it comes down to how they structure contracts and defend their balance sheet. First, the core business relies on inelastic demand.
Meaning the energy has to move regardless of what the broader economy is doing.
Precisely. EPD provides the integral physical toll bridge to make that happen. Upstream drillers have to get product to market. Downstream needs it to power grids.
Right, so think of EPD like an essential toll bridge over a river.
Yeah.
People have to use it. But what happens when inflation hits? Does the toll automatically go up?
Yes, and that is their primary defense mechanism. The earnings slides highlight that roughly 90% of their long-term contracts have escalation provisions.
Wow, 90%.
Yeah, so the fees they charge are legally tied to inflation indexes. If inflation goes up 4%, their fee automatically rises to match it. It ensures their cash flow isn't slowly eaten away over time.
So top-line revenue is shielded. But the Achilles heel for pipelines is usually the mountain of debt they take on to build the things in the first place. How vulnerable is their mortgage?
This is where EPD truly separates itself. They are currently the only midstream company with an A-, A-, A3 credit rating.
That's extremely rare.
It is. And look at the architecture of their debt. They have a 17-year average maturity, and a staggering 97% of that debt is fixed rate.
Wait, 17 years?
Yeah,
So they are locking in debt that won't mature until the 2040.
exactly. And their leverage ratio sits comfortably at 3.00 times.
Okay, so let me translate this. Because of those escalation provisions, the toll they collect goes up every year with inflation.
Right.
But because 97% of their debt is fixed, the mortgage on their system is basically frozen in time. Their biggest structural cost doesn't budge, but revenue scales automatically.
Which means your profit margins just expand by default. It creates tremendous operational leverage.
That's incredible. So with record volumes, inflation protection, and lockdown debt, there must be a mountain of free cash coming in. Let's shift gears to capital allocation. What are they actually doing with the money?
Well, management calls it an all-of-the-above approach. In Q2 alone, they generated a record $2.3 billion in operational distributable cash flow, or DCF.
$2.3 billion in a single quarter.
Yeah. Out of that, they declared distributions of 56 cents per unit, which is up 2.8% year over year. That totals about $1.2 billion out the door to investors, plus another $159 million in unit buybacks.
Okay, I have to step in and push back here on behalf of yield-hungry investors. You just said they generated $2.3 billion in DCF. The release explicitly notes this provided a 1.9 times coverage ratio.
It's massive coverage, yeah.
Mechanically, they generated almost double the cash they needed to pay the dividend. Yet the distribution only went up 2.8%. If a company is sitting on that much excess cash, I want it in my pocket. Why not reward the investor right now?
It's the central debate in infrastructure current yield versus long-term value. After paying out that $1.2 billion, EPD deliberately retained $1.1 billion of cash flow.
Because they're aggressively self-funding.
Right, exactly. They expect their growth capex to be $2.9 to $3.4 billion for 2026. They are retaining cash to avoid taking on expensive new debt at today's interest rates.
Right, but what are they actually building that justifies hoarding $1 billion in a quarter?
Massive organic growth projects. For example, they just announced Frac 15, which is a 150,000 barrel per day NGL fractionator in Mont Belvieu.
And just to clarify for everyone, NGL is natural gas liquids, ethane, propane, butanes. A fractionator basically acts like a giant distillery, heating the raw stream to separate those highly valuable liquids.
Perfectly said. And
Wow.
EPD dominates that space. Alongside Frac 15, they are also building Plant 13 and Plant 11, which are identical 300 million cubic feet per day gas processing plants in the Delaware and Midland basins.
So they have what, like $6.5 billion in organic growth projects under construction now?
Exactly, $6.5 billion. So by holding on to that $1.1 billion this quarter, they secure the future compounding growth of the business without weakening that fortress balance sheet we just praised.
I see the logic. You sacrifice a sugar-high yield today to fortify earnings for the next decade.
Right.
But looking at today's operations, which specific segments are actually generating that $3.0 billion total gross operating margin?
Right.
What's driving the lion's share?
The absolute heavyweight is the NGL pipelines and services segment. That alone generated $1.5 billion in gross operating margin.
So literally half the total pie is just from natural gas liquids.
Yeah. And it was heavily driven by new physical assets, specifically Frac 14 coming online late last year, plus those massive export jumps we saw. Ethane exports were up 143,000 barrels per day, and propane up 141,000.
A perfect feedback loop. Retain cash to build a fractionator. It comes online, generates record volumes, and then you ship those volumes out of your expanded marine terminals.
Exactly. And the natural gas segment was the other standout, hitting $556 million in margin.
Was that mostly Permian Basin growth?
Spot on. Inlet volumes to their Permian plant spiked 14% to 4.3 billion cubic feet per day. Drillers are pulling so much out of the ground that EPD is running at record highs just to process it.
And crude oil hit what, 485 million? Boosted by the Seaway pipeline.
Yep. And petrochemical and refined products achieved 418 million, thanks to record propylene production of 134,000 barrels per day.
Okay, physical volume growth across the board. But if you are reading the fine print of these slides, there is a specific line item we have to address. The mark-to-market, or MTM gains.
Ah, yeah, the paper gains.
Right. The report mentions a $77 million increase in unrealized MTM gains on financial hedging instruments. So I have to ask, how much of this success is real operational muscle, and how much is just a favorable paper game?
It's a vital distinction. Companies use hedges like insurance policies on future commodity prices to protect against market crashes.
Locking in a price for tomorrow so they don't get wiped out.
Exactly. But accounting rules dictate you have to report the current value of those policies every quarter, even if you haven't cashed them in. So because energy prices fluctuated, the perceived value of their hedges went up by $77 million.
So a skeptic might say, aha, 77 million of this is just an accounting trick.
They could, but you really have to look at the total business. The total increase in gross operating margin for the quarter was $514 million.
Oh, wow. Okay.
So mechanically, even if you completely strip out that $77 million paper gain, you still have over $430 million in actual fundamental margin growth.
Right, so the hedging just made a great spreadsheet look slightly better.
Exactly. The overwhelming lion's share of this quarter was physical throughput. Real steel moving real molecules.
Real steel moving real molecules. I love that. So to bring this all together for you listening,
Yeah.
EPD capitalized on global volatility by having the right infrastructure ready at exactly the right time.
Yep.
They're completely insulated from inflation through contract escalators and that masterful 17-year fixed-rate debt profile. And they are aggressively reinvesting their cash into a $6.5 billion backlog to do it all over again.
It really highlights how midstream has evolved into strategically managing capital for a resilient, inflation-proof portfolio.
Absolutely. But before we go, I want to leave you with a forward-looking thought. We talked about the Middle East catalyst. Jim T specifically noted that global shipping continues to face massive disruptions, longer transit routes, permanent reroutes.
The maritime chaos, yeah.
Exactly. If this isn't just a temporary spike, but the new normal for global shipping, does the U.S. Gulf Coast shift from being just an alternative energy supplier to becoming the absolute center of global energy security?
It's a huge geopolitical question. If traditional transit lanes are out, the Texas and Louisiana coasts become the most valuable assets on the global stage.
Right. And if that happens, is there a physical limit to how much infrastructure companies like EPD can even build on the coast before they run out of space or a regulatory runway? We will leave you to mull that one over. Thanks for joining us on this deep dive, and make sure to follow the show for your daily earnings coverage.